Mukesh Ambani has lost $35 billion in the last 8 months.
Reliance Industries
went sub below 1300 as well.
What next for Reliance Industries?
That's 1200 crore rupees every single day. But how can that happen to the most powerful man in India? Well, Reliance is battling problems in every single sector. Its flagship oil-to-chemical business's profit margin is falling. Jio seems to be losing the telecom race to Airtel. Its retail arm is laying off people and closing stores. And its green energy business is running way behind schedule. That's why Reliance shares have been in free fall. It finished the year at a lower price than it started for the first time in 10 years. So how is Reliance losing even after being the biggest player in all these sectors? And is this just a temporary setback or the beginning of Reliance downfall? To find out the answers, let's look at what's wrong with each of Reliance's 4 segments, starting with the flagship oil-to-chemicals business. The oil-to-chemical segment is how the Ambanis became the Ambanis. Its profits have powered everything that Reliance has made so far, the ultimate cash cow. It used to bring in about 75% of its revenue and profits until 10 years ago. However, its contribution has been falling. Last quarter, Reliance got the most revenue from this business at 52%, but its EBITDA profit contribution was just 33%. And this is a clear indication that its profit margins in the O2C segment are falling. In fact, in the first quarter of FY 2024, the O2C business recorded its lowest net profit in 4 years. But after 25 years of dominance, what's suddenly going wrong? See, here is how the O2C business works. Reliance imports unprocessed crude oil from oil-producing countries. The crude oil is brought to Jamnagar, where Dhirubhai Ambani built a refinery 25 years ago. That refinery was so great that it's still the largest crude oil refinery in the world. So at Jamnagar, the oil is processed into 2 types of products. One is fuels like petrol, diesel and LPG, and 2 is chemicals of over 15 different types. These chemicals are used to make several everyday products like plastics, clothes, soaps and car parts. Reliance sells both of them and makes huge profits. Now the problem here is that Ambani's profit margins depend on 2 things: prices of crude oil that he imports and prices of fuel and chemicals that he sells. And in the past years, there have been 2 problems. First was the rise in crude oil prices due to the Russia-Ukraine war. This made the raw material expensive for Reliance, so its profit margins decreased. However, eventually this problem was resolved as Russia started selling cheap oil. But then the second problem came up. Due to the war and other factors, the global economy slowed down and people started spending less. This decreased the demand for Reliance's products, fuel and chemicals. Due to this low demand, the prices of these products went down. To add salt to the wound, China slashed its prices for these chemicals a lot, giving Indians the option to get cheap imports. So Reliance had to match China's low prices, significantly bringing down its profit margins. However, this is only the short-term picture. In the long term, the world is moving away from traditional fuels like oil altogether towards cleaner, green energy sources. So while it was the main growth and revenue engine for Reliance for 25 years, you cannot expect it to grow in the coming years. It should continue to generate the same level of revenues for some years before eventually starting to decline. Now, if even Reliance, India's biggest company, needs to track every rupee for navigating challenges, imagine how important it is for businesses of all sizes. The key to a business's success is smart accounting, and that's exactly what Odoo Accounting helps you achieve. It is a modern and clean accounting software which will change how you manage your company's finances forever. Not only is it ultra fast, but it also offers an experience with zero data entry. Just upload the invoice and Odoo's AI-powered data capture will digitize it for you with a 90% accuracy rate. So the only thing you have to do is validate the invoice. And the best part is that you can also do this with your phone. Take pictures of your expenses and AI will do the rest. But that's not all. Odoo's smart bank reconciliation integrates with 28,000 plus banks around the world. So you never have to import bank statements manually again. AI matches 95% of the transactions automatically with the financial records. It also simplifies financial reporting for you with an amazing dashboard where you can get detailed balance sheets, profit and loss statements and cash flow reports. And everything is 100% in compliance with local Indian accounting needs like GST, TDS and TCS. Odoo also helps you identify late payments and lets you schedule reminders and follow-ups. So you don't need to run after customers to get your money. That's how with Odoo Accounting, you can save your time and improve your business's finances. You can use your first Odoo app for free and you can expand as you grow with multiple other apps in the same ecosystem. So check out Odoo Accounting by using the link in the description. Now, it's not that Ambani Ambani didn't know this was going to happen. He is a visionary who knew very well that one day the sun would set on his oil refining business, and that was why he started diversifying into other businesses, telecom, retail, and even media. While oil refining was supposed to be replaced by their new green energy business, he had all of it planned out well before time. However, what's happening now is something he did not expect. None of these new businesses are performing well right now, starting with Jio and his telecom business. Initially, Jio fought its way in the market by offering everything for free, becoming India's top telecom operator in just 3 years. Even today, it has 7 crore more users than Airtel, and it's now so crucial for Ambani that despite bringing just 14% of the revenue, it contributes the highest profit of all segments at 38%. However, even after dominating the telecom sector, Jio is now facing 3 problems. The first one is that Jio's subscriber base is shrinking. See, Jio wasn't doing charity by offering everything for free. The idea was to attract customers with freebies and then increase the prices. However, when Jio did increase the prices with tariff hikes in July 2024, it took a huge hit on its subscriber base. It lost 1.6 crore users in the 4 months after that. This severely affects Jio's long-term revenue because these customers would have brought a steady revenue stream with monthly recharges. The second problem is that it is not earning enough from each user. Jio's average revenue per user or ARPU is 203 rupees, while Airtel has a much higher ARPU of 245 rupees. So Airtel is earning 20% more from each user than Jio, and this has been happening for about 4 years now. Jio's ARPU growth has consistently been lower than Airtel. But how is that possible when their recharge plans are almost the same? Well, that's because Airtel has always focused on building a premium customer base, so it has a much higher percentage of postpaid users. In fact, Airtel's CEO said that converting a prepaid user to postpaid gives them a 75% jump in revenue. But Jio's postpaid user base as well as ARPU remains low. The third problem with Jio is that the competition is finally catching up. In 2024, every single month, Airtel's internet performed better than Jio. This was across metrics like download and upload speeds. BSNL also disrupted the playground last year by capitalizing on customers' anger over the price hikes. It snatched a lot of new users even though it still offers only 3G internet. Now, the government is planning to roll out 5G on BSNL next year. That could make things difficult for all players, including Jio. And VI continues to be a struggling but permanent third contender. That's why, despite being India's largest telecom operator, Jio is currently struggling with stagnating revenue growth and profits. But Jio was only one of the bets played by Mukesh Ambani. Another huge bet was Reliance Retail, which now brings the second highest revenue for Reliance. It's India's largest retail company with over 18,700 stores across India. This includes Reliance Smart Bazaar, Reliance Digital, Ajio, JioMart, Jewels, and Trends. If something can be sold, Ambani is selling it. However, after explosive growth for almost 2 decades, Reliance Retail is now also dealing with no growth. If you see retail's year-on-year performance, the EBITDA has remained the same while the revenue has actually decreased. So why is India's biggest retail chain suddenly failing? See, Reliance Retail's revenue comes from 3 major categories. 43.5% comes from consumer electronics, 37% comes from groceries, while 19.5% comes from fashion and lifestyle products, including apparel. And it is facing competition in all 3 segments. In fashion and apparel, which has the highest profit margins, Tata Trends Zudio has been stealing its lunch. Zudio now has over 600 stores in India and continues to expand. When it comes to groceries, it is facing tough competition from multiple players. DMart continues to post strong profits with unbeatable prices offline, while online, quick commerce players are on steroids, doubling their revenue every single year. At the same time, Reliance's own attempt at 10-minute delivery, JioMart Express, was shut down. And to make things worse, its strategic investment in Dunzo also vanished last year. And when it comes to the biggest segment of consumer electronics, Amazon and Flipkart continue to steal offline customers. So Reliance Retail is surrounded by troubles on all sides. However, this was something that Ambani did not see coming. He had invested crores into Reliance Retail to grow it as fast as possible, expanding with thousands of new stores and locations every single year. But since they are now turning out to be unprofitable, Reliance is being forced to scale them back. In 2024, Reliance Retail laid off 38,000 employees. From July to September 2025, it opened 464 new stores but closed 436 stores, effectively opening just 28 stores. And without new stores, there is no revenue growth. Now, technically, it's good that he is consolidating and trying to improve profits. However, it also indicates something else. Even with Ambani's deep pockets, scaling profitability in retail is not easy. That's why investors have dropped its valuation from $125 billion 2 years ago to just $50 billion as of now. But Ambani's bets did not end here. As the world moves from fossil fuels to green energy, Reliance said it will follow that same path. So in 2021, Ambani revealed a $10 billion investment plan for his new energy business, where he would become the biggest player in 4 things: solar panels, lithium-ion batteries like those used in EVs, green hydrogen, the fuel of tomorrow, and hydrogen fuel cells. Effectively, Jamnagar would turn from the largest crude oil refinery into the largest green energy producer. And green energy will bring as much money for Reliance as oil to chemical does right now. However, back then he also said that the production in all 4 of them would start by 2024. But it's 2025 and none of these facilities have started manufacturing yet. Everything is delayed. The deadlines have now been pushed to the end of this year. So it's been 4 years that Reliance has been pouring money into green energy without any revenue or profits to show for it. Other than the $10 billion green energy commitment in 2021, Reliance has also spent $13 billion on acquisitions in 5 years. Many of these were for the new energy value chain. But since Reliance is behind schedule, these projects have not contributed anything to the profits and instead dragged down Reliance's cash flows while increasing debt. And then there are other problems as well. Despite acquiring Hotstar, its media business is still not profitable, with hundreds of crores in losses last year. On top of that, the government slapped a $2.8 billion demand on Reliance just a few days ago because it allegedly stole gas from ONGC's underground reserves. And due to all these reasons, Reliance has been falling steadily since July 2024. Its share price has dropped by over 27% from its peak. So does this mean that the sun is really setting on Reliance's mighty empire? Well, it's not wise to jump to that conclusion yet. Reliance's revenues may not be growing as fast as they used to, but they're not falling either. We are talking about a company that did 10 lakh crores in revenue with 79,000 crores in profit last year. I repeat, 79,000 crores in profit after tax. And if you take a deeper look across all its verticals, the long-term prospects still look promising despite short-term troubles. In the oil to chemical business, the demand is always cyclical and it fluctuates. So while it has been down for the past few quarters, it is expected to bounce back in the coming months. This will likely lead to a recovery in its refining margins. However, this still doesn't change the fact that the world is moving away from crude oil, right? But that is where Ambani's green energy bet can give a huge payoff. Its new energy business and solar business are expected to reach valuations of $40 and $30 billion respectively within the next 5 years. Almost 60% of the promised $10 billion green energy investment is already done, and the time to reap those profits is now coming closer. By 2030, it aims to generate 100 gigawatts of renewable energy. That would be 20% of India's entire capacity by that time. In the telecom segment, Reliance Jio might be behind Airtel in terms of average revenue per user, but that would change quickly in the coming months. It will continue increasing the tariffs even if it loses a few subscribers, which will improve overall profitability. After the last tariff hike, its EBITDA increased by 18%. It is aggressively pushing its home broadband and 5G services to increase its ARPU. And when it comes to 5G, Jio has a fundamental advantage over Airtel. While Jio has been building a separate 5G infrastructure from scratch, Airtel has just been converting its existing 4G network to support 5G. While Airtel's method is cheaper and faster, it is only Jio that can offer the full benefits of true, pure 5G with the ability to support advanced applications. That's why in the long term, only Jio's pure 5G network will attract more premium and corporate customers, giving it much higher profits and market share. Even today, Jio continues to be the world's largest 5G operator outside China. In fact, Reliance is planning to separate both Jio and retail into separate companies and then take them public. That is going to unlock a lot of value. Jio is preparing for a 40,000 crore IPO at a $120 billion valuation, the biggest IPO in India's history. And after the consolidation, Jio Hotstar has become a monopoly in the OTT space. So a lot of Reliance's problems seem to be short-term and self-inflicted for the sake of longer-term gains. Now, whether Ambani is able to pull off everything he is promising or not, that is what you should closely observe in the coming months. If you want to launch your own D2C store, check out the link to my e-com masterclass in the description below. Like and subscribe here and follow me on LinkedIn and Instagram using the links in the description. If you like this video, I recommend watching this one next. Until I see you in the next video, goodbye.